Welcome to another video by Dale Wheatley, founder at theoptionshunter.com. Subscribe to our channel at the end of this video, and let's start your journey to financial freedom.
Good afternoon, everyone. It is Monday, March 31st, 4:55 p.m. Well, if you notice today, not as if there was any divergence or anything, but the volatility popped up on the open, which means downside move in the market. But that's why you can't follow it, see, because there's no pattern. And that's what I was trying to explain the other day. Say, well, it'd be great, take advantage of it, but what are you going to take advantage of? And then the same thing on the downside. Well, it's a nice slide to the downside on volatility, and market moved up a little bit. So I guess that's pretty good. But where does it start and where does it end? That's the problem that you have when you don't have any pattern to define what you're going to do, what you're going to do, not what already passed, you know. So there really wasn't any good opportunity as far as trading options goes today. And like, for instance, these 468 um, on the QQQ, so they went from 12 cents. It wasn't even below 10 cents, but I just picked one 478. So I mean, 468, 78, whatever. Went from 12 cents to a dollar and something. Okay. So what? You made 8, maybe 9 times your money. So okay, great. That's fantastic. Show me the pattern that defines that you should be entering into anything. Hmm. I find that a little bit different, difficult to discern from. I don't see anything here. Do you see? Say, yeah, I don't see anything. This technical pattern is lower than that one over here. Maybe it wasn't quite as low as the price was reflecting, but so what? You know, you're still taking a chance on things, and that's the difference between things that you've seen in the past that produce 50, 60, 100, 120, 150 times your money in the same period of time, in less than a day or whatever it is, same period of time, but have a good pattern that is underneath the price or on top of the price, whatever, to drive it. So, yeah, 8 times your money versus 100 times your money, 120 times your money. There's no comparison. That's why I don't have any interest in this kind of thing. So, let's see if the SPY was any different. Do you guys see anything different down here? Like the price? No, I don't see anything different. See 15-minute. No, it's a little better than the Qs maybe, but I don't really see anything there. And then so you keep dropping down. So the 10-minute chart, see, you do have a pattern, but here's where the rubber meets the road. 25, 331 call, and 5, let's say 560. See, they were like this. I break it down to a little lower time frame. So they were late in the day. They're 3 cents. About 2 o'clock even. They were 3 cents, and they moved up to oh 88 cents or 90 cents or something like that. So that qualifies, you see, where the Qs, let's see, take a look at it again. See, now Qs don't qualify. There was no divergence that was clearly set out. You understand? So no comparison between the Qs and the SPY. Let's see, how about the Russell 2000? Uh, Also did have a divergence. So, and the Russell, oftentimes the options are cheaper. But remember that they extract premium because the volatility is coming down. So it's harder to make money on the call options on a reversal like this than on the put options. So let's see, Russell 2000. 200. They remember about 7 cents, and they moved up to 49 cents, so, there was a little bit of money to be made, but it didn't last till the end of the day on those, because it didn't close over 200. That's right. So all in all, it appears that the Russell 2000 and the SPY were the most definitive patterns. And the SPY in particular was a good mover. So about 3,000% on the options on the SPY. So that's good. Pretty good day. And you had another opportunity here at about 2 o'clock when it started to rebound. So take a look at the options. If you missed the first part of it, five, 6, 0, right here. See what I mean? Right about 2 o'clock here. So really the options went sideways for most of the day until that time, till about 2 o'clock. So it was that extra little boost that it had, but it had a divergence to begin with. Makes sense because that's why um, the options don't move as quickly when the volatility starts to fall. So it's they're extracting premiums, so you've got to make up for the fact that they're extracting premiums with the price movement's got to be greater than the extraction. You see what I'm saying? It's a it's a formula that they are using. It's not necessarily anything that we can calculate, but we can see it and we can see the evidence of it. So anyway, these were about I don't know, and maybe I don't know, maybe 3 cents, 5.60, 3 cents, and they moved up to 83 cents and 80 $1.20 if you caught them right there near the end of the day to 3.40. So, but then it dropped back down, so very very quickly dropped back down. So uh, only closed at 12 cents, so it wasn't much of a profit at all. So you got to be careful about buying options if you don't, especially when you don't seeing a pattern and the volatility is not really going along for the same ride, like it's up and down, up and down. Like, I don't know, that's a little sketchy. So that's what you get at the end of the day. So you don't hold them till the end of the day, in other words. You get rid of them before the end of the day, and you have a good profit. Because if you held them, profit disappeared quickly because it has to go over the 560 strike price for these. So got to be greatly over it. So talk to you later. See you tomorrow afternoon, 2 o'clock. Talk to you then.